So first of all, my name is Peter Young. I'm president of Societe de Chimie Industrielle and also head of programs. And I want to welcome all of you for this very special webcast featuring Scott Wolff of American Securities. Before I introduce him, and I would like to just first of all thank our sponsor, which is Alvarez and Marsalis, for being a sponsor for this event, a diamond level sponsor. I want to remind you that Societe de Chimie Industrielle is somewhat unique in that almost all of the money that we get from sponsors for various events go towards scholarships for students studying chemical engineering, chemistry, or biotech. And we're very, very proud of the fact that we do that. So I want to thank our sponsor today. And also, I want to just mention a future event. Our next monthly webinar will be on November 18th, and it's going to feature the topic of career opportunities at startups for chemists, biochemists, and chemical engineers. We have three very, very good panelists who come from different angles, whether it's an operating partner at Ampersand Capital or a co-founder, CEO of photothermal spectroscopy, or an angel investor from the Lehigh Valley Angel Investors. So it'll be a very wonderful panel and moderated by Mark Reich, who is a board member and also who is head of our education program. This topic today is actually very, very interesting because if you go back in history, private equity didn't really have a role in the chemical industry up until about in the mid 90s. And then they just sort of discovered the industry. And there were a lot of reasons why they were reluctant. One, of course, we have product names that are almost impossible to spell or pronounce, but also there was a lot of uncertainty about things such as environmental issues and so forth. But I think a number of pioneers, such as D. George Harris and others, did deals that were very successful and caused a lot of people to rethink the industry. And as a result, the private equity industry has actually now been very heavily involved since then in the chemical industry. And they have a very important role for a lot of reasons. But it's been up and down the last 10 years, and the trends are different, whether you're talking about specialty chemicals or commodity chemicals or the US or Asia and so forth, and we'll be commenting a little bit of that. We're very, very pleased to have Scott Wolff. He is a managing director at American Securities. I've known Scott since 2010, I think that is, right? Or maybe 2029, when we looked at doing deals together. Very pleased that my firm was involved with helping them do the Arizona Chemical deal. They have been extremely active, mainly under Scott's oversight since then, and have done a lot of different deals and very successful deals. So I'm very, very pleased to have him. As you can tell, like everyone else, he is working out of his home, and his real office has a better view, right? And fewer children, right? I guess that's right, Scott. But what we're going to do is for this 1 hour event, Scott's going to go through some slides talking a little bit about American Securities and their history and some of their philosophies as they've done chemical deals. And then at the end of that, we'll do a fireside chat, and I'm going to ask Scott some questions about his own career, but also maybe his perspective on where things stand in terms of chemicals and its relationship with private equity currently and looking forward. So with that, I want to turn this over to Scott. What I'd like to do though first is I'm going to open up his presentation. and put it on the screen, and then let him begin his talk. It's coming up.
While it's coming up, hopefully I do have 3 young kids, and they do have half days at school today, so they're home. So I'm hopeful we have no interruptions. But such is the world we live in today with Zoom interruptions. But hopefully that doesn't happen today.
Are they going to present some of the slides, Scott?
They could. We'll see. They've heard about some of the companies for sure, so I could probably talk a little bit about them.
Okay, terrific. Okay, Scott, please.
Great. All right. Well, thanks, Peter, and good afternoon, everyone. Maybe like a lot of us, I am on Zoom. It feels like all day, every day, and have been for the last number of months. I think this maybe takes the record, though. Peter tells me there's 100+ people.
I can't see it. It is a record for a webcast, so okay. So, you set a high bar now, right?
Well, I can't see everybody. I think this probably takes the record for me, as most people on at once for my Zoom life here over the last number of months, but. As Peter said, Scott Wolff, Managing Director at American Securities. I joined our firm in 2002, so about 18 years ago. And I do lead our chemicals effort. I've been leading that effort for, as Peter said, for the last, I guess, 11 years now. And what I thought I'd do today, which Peter alluded to, is give a little bit of an overview of American Securities, our history, and what we're focused on as a firm, and then talk about our chemicals background and what we've done in the space, what we look for in the space, as well as what we do post closing and making an investment, and how we try to add value. I will start on page 1, Peter, if you can move to the next page. So our mission and our values, this is the first page in every American Securities presentation, and it's not just words on a page for us. We really live by our mission and our values. Probably not surprising to anybody listening to this that our mission is to generate returns for our investors. That, of course, is the business we're in. But how we do that's really driven by our values, the words that are on the page here. And this is something we think about every day. It drives how we interact internally. It drives how we interact with third parties, whether that's investment bankers or our lending partners or third-party consultants. It importantly drives how we interact with our management teams, and we're constantly looking at this, and we're adjusting these words and making sure they reflect who it is we want to be, who we strive to become. So a very important part of our firm philosophy. If you turn to the next page, you'll see a little bit of our history. So we grew out of a family office. The Rosenwald family was Julius Rosenwald was one of the original Sears Roebuck investors and presidents way back in the early 1900s. His son William started the office to invest the family money in the 1940s. Eventually had other friends of theirs, other wealthy families come to them and asked to invest alongside of them. They agreed to do that. Eventually that became a bigger part of the business, and in 1994 they formalized the first private equity partnership, a $70 million fund, largely the Rosenwalds and other wealthy family investors. If you fast forward to today, currently investing our 8th fund, it's a $7 billion fund. So obviously we've grown quite a bit in terms of fund size. With that, we've also diversified significantly in terms of our investor base. We actually do still have a large number of wealthy family investors in terms of number of investors, but in terms of dollars, much more diversified to other institutions today. But I give that quick history because those early investors still influence how we think about investing today in a couple of different ways. One is that they tended to be very focused on capital preservation. Not that everybody isn't focused on capital preservation, but their number 1, 2, and 3 rule was don't lose our money. And so that influences the types of businesses we look for today, and I'll talk a little bit more about that. 2, they tend to have a longer time horizon. They had created generational wealth. They didn't need immediate returns on capital, and so they were looking for places to find good places to invest their money and generate returns over a longer time period. Today, our fund has a 25-year life, which is pretty unique within private equity. To be fair, highly unlikely we're going to be holding businesses for 25 years, and our average hold period is closer to 5.5 or 6 years. but it does give us a lot of flexibility in making decisions for our companies that are in the best long-term interest of the companies we invest in. And then third, they really believe they needed to be value-add investors, so more than just passive financial investors, and I'll talk more about how we do that today. If you go to the next page. So just some stats. So over $23 billion of committed equity since '94. We've made 66 platform investments. So those are new platforms. If you included all of the add-on acquisitions that our companies have done, I actually don't know the exact number, but that's more like 260 or 360. Not that all of our companies are acquisitive, but the ones that are tend to be very acquisitive. As I mentioned, investing a $7 billion fund today, we're typically looking for businesses between 50 and 250 of EBITDA. Really, the sweet spot is more like 100 to 250. 50 is on the small side for us, but for growth investments, we will look for companies in that range. And generally looking for 300 to $700 million of equity. Portfolio today has almost $20 billion in combined revenue with 93,000 employees. And then the bottom part here, our partnership with management. We don't have a bullpen of CEOs that we bring in to run our companies. We typically are partnering with existing management teams, and that's why that second bullet point is very important to us. So the low CEO turnover. We very rarely have a CEO that gets replaced. It happens. So if we have to make that decision, we do, but we tend to think a lot about the CEO partnership going in. And then the resources group is one of the ways we help our companies, and I'll talk more about that in a couple of pages. Go to the next slide. Sorry, the next slide. So this is our basic investment philosophy. Probably looks somewhat similar to other private equity firms. We look to invest in leading companies. We define that as either leading market share or a scale player that's growing and gaining market share. Attractive industries we define as long-term stable demand. So with a 25-year life, we can clearly ride out market cycles. So, and we're not afraid of market cycles, but we're looking for long-term stable to growing demand. Capital preservation is critical for us, getting back to what I talked about with our early investors. We tend to look for businesses that have moats around them that we think have competitive advantages today, but more important than just today, competitive advantages that we think will stand the test of time. And I'll give some examples of that in chemicals. And I talked a little bit about the management teams, and that piece in the middle of making it better together, again, really important to us. Clear to us that our management teams are running the company, but we need to help support them to make the business even better. If you go to the next page, our track record. So we're proud of our track record. We've generated gross returns of over 25% for our investors, more for our management team since they disproportionately share in the economics through equity incentive plans. That's what's allowed us to continue to raise these larger funds. I think the most important bullet on the page for me, though, is the second bullet, the loss ratio of less than 7%. We've generated those returns not by making 10 times our money on a couple of deals and losing money and all the rest. We have a good consistency across the portfolio. And while at the fund level, we at American Securities have diversification, our management teams don't have that same level of diversification. They're disproportionately invested in their business. And so that matters a lot more to them. And it's also really important to them because they're our partners in all of these investments. Go to who we are. Go to the next page, Peter. So two sides to our organization. We have our investment team, which I mentioned before. I'm part of. Our job is, what I think of as pretty typical private equity. Our job is to source new investments. It's to lead the diligence effort on those investments, and really work closely with our management teams at the board level post-investment, working on strategy, working on key initiatives with the teams. To help in any way we can and use our past experiences across other portfolio companies to help support the teams. We have about 35 individuals on the investment team today. If you go to the next page, you'll see a little bit about our resources group. And now I'm going to pause here for a little while because this is pretty unique within private equity. Our resources group is 50 full-time American Securities employees, so meaningfully larger than our investment team. And they're functional experts in things like strategy, IT, operations, human capital, procurement, pricing, sales force effectiveness, FP&A, Asia strategy, Asia sourcing. And there is a free resource to our management teams if and when desired by the teams themselves. An example, we have about a 10-person US strategy group, oftentimes ex-Bain or McKinsey folks. Sometimes they're there to help our companies think about company-wide strategy. Sometimes it's go-to-market strategy for a new product or new geography. Sometimes it's just a market study on an adjacency where a CEO says, I'm really interested in this other area. I think we have some products that would serve that industry well, but I don't really know the competitive dynamics or the growth or the pricing. Don't really want to pay McKinsey $2 million to go do that study. We'll do it for free. If we all agree it could be an interesting path for growth for the company. We don't want the cost to be a barrier. And again, we don't charge for these resources. When I joined in 2002, this group didn't exist, and it's gone from 0 to 50 individuals because they've been in such high demand from our portfolio companies, which probably not that surprising if we hire the right people and they're free. Easy for our CEOs to ask for their help. What you won't find in this group is a chemical industry expert. So unlike some other firms, we don't have operating partners. We don't have somebody in this group that has 30 years of chemical industry expertise. They're all functional experts there to help our portfolio companies. You go to the next page. From an industry perspective, as a firm, we are industry generalists. So you'll see a lot of different companies representing a lot of different industries on the page here. But we do specialize at the individual level. As I mentioned, I lead our chemicals effort. One of my partners would say the same thing about building products. Another would say the same thing about packaging. Another on aerospace and defense, services, power and energy, healthcare, et cetera. So we get the benefits of diversification, but also benefit from specialization at the individual level. If you go to the next page and one further. So talking a little bit more about chemicals and our focus in the space. So it's one that we've committed significant time and resources to really over the last decade. Peter mentioned we partnered with him and his colleagues, a good 10 years ago to go identify potential opportunities in the space, and been working on new opportunities since then. You'll see the investments we've made here. I'm not going to go through each one of them. Some of you may be familiar with all or some of them. You will see a pretty diverse group within chemicals, so they're all different. We do have a number of themes that we invest behind, and each of these fits one of those themes, but they're all different. If you go to the next page, maybe just talking a little bit more about some of the things that we're focused on. In some ways, these are the things we're focused on across a wide range of industries, but particularly within chemicals. And if I think about getting specific about a few of these items, so when I talk about market share and leading market share, and think about some companies in the portfolio, think about Emerald and Emerald Kalama Chemical, the clear global leader in toluene oxidation for benzoic acid and benzoic acid derivatives. Chromaflow, the global leader in liquid colorants. Arizona Chemical, by far the global leader in refining pine chemicals. I think about capital preservation. I kind of group the next two bullets together in some ways, capital preservation and defensible advantages. You find if we're investing in the long-term stable to growing demand industries I mentioned, and we're investing in businesses that have market leadership positions with an advantage, goes well to not losing money. And we can find those competitive advantages in lots of different ways. Think about Royal Adhesives and Sealants, really formulation expertise across a wide range of markets that gave them an advantage over other competitors. General Chemical is a business we own that produced aluminum sulfate largely for municipal drinking water applications. They had a plant network across the US, something like 40 different sites, shipping product as a 50% aqueous solution, needed to have the geographic advantage to be able to ship effectively, and that provided a competitive advantage for that company. Arizona, differentiate access to raw material supply for a supply constrained industry. Emerald with technology and expertise, as well as significant capital to compete for its toluene oxidation facilities. So all very different. We find that we can define those defensible advantages in lots of different ways and find them in different ways within different chemical companies. Secular tailwinds in growing end markets. Here, some examples: Royal with adhesives gaining share versus mechanical fasteners in transportation and construction, and they're benefiting from that. Emerald benefiting from favorable regulatory environment. MECS, at the time we made our investment, was designing sulfuric acid plants largely being used for fertilizer. And you had the tailwinds of growing middle class population requiring more fertilizer. And then multiple earnings growth levers. So, important for us in our investments really to have more than one way to win, to drive value. And so we're looking for businesses that we're not making just a single bet. There might be a larger bet within the portfolio, but we're looking for multiple bets to win. And I'm not going to go through individuals, but that could be individual companies. But that, of course, can be organic growth. So businesses that are benefiting from market share gain or some of those tailwinds that I talked about. M&A is not the answer for all of our companies, but for some of them, Royal being an example, it was a significant contributor to value creation. There was multiple paths to M&A. It wasn't counting on one acquisition. It was counting on lots of smaller acquisitions. Cost takeout can be a significant opportunity, and I'll talk more about how we do that on the next page. And then exit opportunities. There's been some businesses where you can't count on the next buyer paying a higher multiple, but you might have a situation where there are multiple ways that you could see achieving a higher exit multiple for strategic buyers or IPOs or whatever the answer might be for that particular company. And then again, management critical to us. We're not positioned. We don't know how to run companies. It's not our business. We are working with our management teams to support them in running their businesses. So each of the companies that were on the prior page, I could walk through and talk to you about how strong the management team was and how they were well positioned to execute on their plan to grow the business. If you go to the next page, so I talked about our resources group and some of the value they add, and you'll see some specific things here that we have focused on in chemicals in particular. Procurement has been a very big driver of opportunity at a number of our companies, in particular ones that have grown through acquisition. So Prince is a business that before we bought it had been put together through, I think, 21 acquisitions. We'll generate almost $20 million of procurement savings from Prince. And that was driven by us putting a 4-person procurement team from our resources group on site at Prince for almost, 16 months. I'm working with the Prince team to drive those $20 million of procurement savings, which we're realizing as we speak. Operations, we have multiple operations folks as part of the resources group. In some cases, they're working with our companies on lean initiatives. In other cases, it's footprint rationalization, where we have shut down plants at Prince, for example, where they had a lot of small plants that weren't necessary as part of the network. We did the same at Arizona, where there's a couple of small plants that didn't need to be operated. Pricing, not a lever in every business, but a lever in a lot of specialty chemical businesses. And we work with our teams very closely with our teams on value pricing. Some of them are world-class and doing it already. Some are early in their development of value pricing and can work with them to drive that. There's also pricing leakage. A lot of our companies focus on the headline price and don't focus on some of the leakage that may occur through rebates or expedited freight or a whole bunch of different things that that can be a deduct to pricing. And so we take an analytical approach to that with our companies. Our organic growth, I talked a little bit about the strategy team we have, and we've worked with a number of our chemical companies on market assessments and go-to-market strategies. And what I didn't talk about was new product development, which we found that a number of our chemical companies we've invested in, which could be carve outs or could be other private equity owned businesses we've bought, are really underinvested in the resources required for new product development. Those could be people in the lab and R&D dollars. It could be commercial resources. For us, we're, again, with a longer term perspective, we're not focused on quarterly or sometimes even annual earnings. Of course, we have annual budgets, but really focused on the longer term value creation. If that means we need to invest in additional resources today to drive value later, create new products, we're willing to do that. And I would tell you, for most of the investments we've made in chemicals, we've added costs to the company and added resources to the company within our first 2 years. A lot of that for the payoff down the road, with the hope that those resources will have a strong return. But as we know, especially within specialty chemicals, it's not necessarily a 3 or 6 month payback. It takes time to develop new products, to introduce those products to customers, to go through testing, depending on the industry and end market. But that's an investment we have and continue to make. Asia, we have as I mentioned briefly in the resources group, we have a 10-person group in Shanghai today. They help a lot of our companies think about their Asia growth strategy. Some of those companies are very well established and don't need our help. Some are still early on in Asia, not just China, but Asia more broadly, and can use our help. We've helped a couple of our companies find sites in China to actually build greenfield. We helped MECS find a catalyst plant to build in China. And then, as important is the competitive threat assessments. This helps us on diligence a lot, but it also helps our existing portfolio. It's pretty amazing what our China group can do if you give them a couple of days. They can talk directly to whether it's the competitors or customers, and the amount of information that those competitors or customers are willing to share is just very, very different in China than it is in the US. And that's not going around them. It's telling them exactly who they are and what they're trying to do. But the information sharing can be just really helpful, and it's just helped us make better decisions, again, from an investment perspective, but also for our companies. And then M&A, we're of course set up to do M&A as a firm. It's what we do every day, and we help support our companies both in terms of identifying new opportunities, but also helping them on diligence for some of our teams that maybe don't have all the resources to do the internal diligence themselves. We're set up to support them in doing that. So this has been this post-closing value add's critical for us, especially in today's competitive world. We can't count on just buying a good company and hope it gets better. We're paying market clearing prices, and in a competitive world, we need to really find ways where we can support our companies to help our management teams maximize the value of the companies they're running. So that's kind of a lot pretty quickly on American Securities and how we approach chemicals. Peter, maybe with that, I'll turn it back over to you.
Okay, terrific. Well, thank you very much, Scott. Actually, it was very, very helpful because it sort of lays out a lot of things, including sort of your philosophy and how you operate, et cetera. Before we talk about your perspective about the industry and the intersection between private equity and chemicals in the future, I just want to start with just saying, how did you personally get into the private equity business? I mean, I think there are a lot of different stories about how people got in, sometimes from the financial world, whatever. So how did you end up in private equity and figuring out that it made sense for you?
Yeah, from a private equity perspective, I was sort of in your shoes for a little while. Spent several years in the M&A group at Merrill Lynch, doing M&A investment banking, and I was kind of looking at it and working with a lot of private equity firms as we were selling companies to them back in the late '90s, and thought their job was more interesting for me anyway. I looked at it and said, I kind of like the way they're approaching companies. I liked actually working with companies for some period of time. And I often found myself wondering what happened to the company we sold, what happened with integration, or what happened with the management team, and decided to try the principal side of the business. And that's when in 2002, I left Merrill Lynch and joined American Securities. kind of thought I was going to be there for a little while and then decide what I wanted to do longer term. And I guess 18 years later, I'm still here and still seeing deciding if this is what I want to do. And I think I found a home.
Yeah. Well, it's not uncommon for people from investment banking to go into private equity. But what I've observed over time, because actually I was with the Whitney private equity firm, the Whitney family office before I went to banking. And by the way, I was at Bain& Company before that, fixing chemical companies. So that's how I got into chemicals and life sciences. But it really is a special blend of sort of interests and skills. And it's not just financial, it's not just strategy. And a lot of it is how you work with management teams, right? Because you have to know what you know and what you don't know, right? And
Sure.
and that's important to the success, no matter who you are, right? But there's certainly different flavors among the private equity firms, right?
Definitely. As I talked a lot about, is we focus very much on partnering with existing teams to the extent we can. And yeah, you mentioned it, but a lot of my job today is working with those management teams, right? There's of course the investment part of it, but I spend a lot more time on, I'll call it, people related issues or opportunities than I ever expected. And so really working with those teams, because it's the people that are running the business, right? It's really the people, and working with them is just critical to success.
Yeah. Now let's talk a little bit about the two sets of questions I would ask. One is, it's interesting with something like a firm like American Securities, where pretty much, your charter is any industry that you think makes sense, right? So you decided to get more into chemicals, right? Chemicals wasn't part of your original strategy and the original investments. So what was it about chemicals? Because you could have chosen, there's so many different industries, right? That could fit the criteria that you laid out before. So what was about chemicals that attracted you? And I know we met in the early years when you were saying, should we expand? And has it turned out to be what you thought, right? In terms of what was good and but maybe what was bad, et cetera.
Yeah. So obviously as a firm, we're still looking at investments across a wide range of different industries. But for me personally, we hadn't been really focused on chemicals. In 2007, I think it was. We ended up making an investment in MECS, Monsanto Envirochem Systems. They design sulfuric acid plants, provide catalysts, mist eliminators, other products that go into the plants. And whether that's a pure chemical company or not, I don't know. But it was enough in chemicals where it said this is kind of interesting, and we're not really focused in this area. Maybe it makes sense to go spend some more time. It's kind of the right time for me to try to figure out where I wanted to spend more of my time from an industry perspective. And in 2009, we ended up taking Gentek private. Gentek was the largest piece of that was General Chemical. And it kind of built upon itself, right? It was the right time for me to say I'm interested in exploring an industry, and nobody else was in American Securities was focused on chemicals. We looked at chemicals and said, it feels like we can find a lot of businesses that fit those attributes that I mentioned, that are market leaders and that have sustainable competitive advantages, which you don't find in every industry, but there was a lot in chemicals we thought we'd be able to find. And, frankly, once you've made an investment or two in a space, it's a lot easier to find more opportunities because you've built up a little bit of knowledge, you've built up a little bit of credibility. Yeah, if nothing else, you have more talking points to talk to executives or bankers or consultants about the industry. And I started off spending maybe 10, 15, 20% of my time, and over 3 or 4 years I found that becoming 70, 80, 90% of my time as we made more investments and started having a lot more dialogue in the space. And today it's not 100% of my time, but it's probably 90% of my time, maybe 80, 90% of my time. And the other 10% tends to be other industrial businesses that have some connection to chemicals. Chemicals touches everything.
Well, one thing's for sure, Scott, is you didn't choose chemicals so that at cocktail parties you could say, I invest in chemicals, and people say, wow, sounds sexy, right?
Sulfuric acid, pine chemicals, benzoic acid, not the most exciting topics for most people.
Yeah. Now, one a special question is with the pandemic, obviously, which no one could have predicted that we would have this this coronavirus. what did you do? You had a pretty substantial portfolio in chemicals, uh, beginning of this year. Could you sort of walk us through sort of some of the things that you did in order to get through that period, where just a whole lot of things happened, many things uncertain about, all sorts of stuff, supply chains, you name it, right? So maybe you can share with us some of the things you did in terms of making sure your portfolio of chemical businesses got through in good shape.
Yeah, I mean, first and foremost, it was the safety of the employees of all the companies. Especially in those early weeks or months, thinking back to March and April, it was making sure that we were operating plants safely, that we were doing the right thing for all of our employees and all of our companies. We're on the phone with all of our CEOs on a daily basis, talking through what safety protocols they were putting in place, whether it made sense to operate at all. People are figuring out work from home, and work from home is somewhat easy for somebody like me, but not as easy for somebody who's working working at a plant at ChromaFlow or Emerald. But it was critical that we operated safely. Then there was just the uncertainty of whether we'd actually be able to run, right? The early days where the country and states were figuring out whether individual companies and plants would be designated as critical and needed and could operate. And so there was a lot of uncertainty there for a period of a number of weeks. There was some lobbying being done with various governments to make sure we could operate where we thought we could do it safely. And lucky for us, I don't think we had maybe a couple of small plants that were asked to shut down temporarily. Most of those actually in other countries, but nothing significant in terms of being shut down for an extended period. Then we turned to liquidity, right? It was unclear, especially in those early days, what was happening in the world, how bad things were going to get. And so we were very focused on liquidity for our companies. We were very focused on contingency plans. What happens if we're down for a significant period of time? What happens if we're in minimal or zero revenue situations for a period of time because we can't operate? And what are our contingencies? What can we do? And every company developed a detailed plan, some of which they acted on, some of which they kept in their back pocket for in case things got worse. And as we got through, I'd say March, April into May, we realized that things were bad, of course, related to the pandemic. And I'm not going to get into the lives lost and everything related to that, which is obviously very sad for lots of people. From a business perspective, we realized that the world wasn't falling apart, that our customers were still buying, our suppliers maybe had their own supply chain issues, but in general were supplying. We were, our workers were, with a few exceptions, and we're operating safely with limited cases of the virus. And so we started to turn to offense. We started to say, okay, we're well positioned. Not everybody around us might be as well positioned. What should we be doing offensively? That went from anything from trying to gain market share because we could operate and supply customers that maybe some of our competitors couldn't, and how do we capitalize on that? And in other cases, M&A. What opportunities may exist and be unique at this moment in time to go acquire, and spend a lot of time focused on that. So that's sort of the last few months for us.
So Scott, is it safe to say that you were very pleased that you were not head of the American Securities entertainment industry group for cruise lines, theaters, and et cetera?
For certain, our chemical businesses were not hit nearly as hard as some of the more consumer-oriented businesses.
Yeah, no, that's right. And it's interesting because the hallmark of good companies and private equity firms in this year has been the ability to quickly figure out structurally, one, safety and all those other issues with people and how to work remotely, but how to shift and pivot your strategy based on what the hand you're being dealt. I mean, Societe is a great example. Here we had the core part of what we did was monthly in-person meetings, right? And speeches. And we quickly realized that was not going to happen for a long time. So rather than just get depressed and complain, we pivoted to virtual things. And one of the board members had an interesting quote that says, never let a good crisis go unwasted, wasted. And I think there's a bit of truth. So the fact that you said that you also tried to think about offensive things of opportunities coming out of the calamity is probably it's a good measure of good thinking, right? Now, but with all this pandemic, we all hope that it is over at some point, with vaccines and drugs and so forth and good practices. But even so, I think a lot of people feel that it won't go back to the way it was in December, January, November. There'll be structural changes. Do you feel that way? And has that affected sort of how you either direct your companies or your sort of investment philosophy in terms of if you do feel that there might be some permanent changes going forward?
Just to clarify the question, do you mean within the chemical industry or you mean within private equity and how we think about it at American
Well,
Securities?
chemicals, but American Securities generally, right? Because
Yeah.
a lot of businesses, right?
Yeah. I mean, I think there will be some important changes. Again, for us, the work from home environment from a private equity perspective is not the end of the world. We can accomplish a lot on Zoom. Our office, in fact, is open in New York City. On average, we have about 15 people there a day, where typically we'd have 110 or so. So we're not asking anybody to come in if they don't feel safe, but we're also opening up for people that want to come in. We actually have a meeting on Friday to talk about what we've learned from this and what we will actually do differently when things return to, I'll call it normal, for whatever that means. So I could give you a better answer next week.
Yeah.
I'd say one thing we've realized is some travel is critical, and I have traveled a couple times during the pandemic, and sometimes you need to have a face-to-face meeting with individuals. But a lot of the travel we do, and we travel all the time, is not maybe as critical. Maybe the board meetings we do 4 or 5 times a year for companies that we've invested in for several years. Maybe that's 2 times a year, and you can avoid some of those travel days because you don't get a lot of out of the extra travel for those companies. More important, I think, early on in our relationships with new management teams. I think we've learned a lot about face-to-face Zooms versus calls. So even for things we do regularly via call, we now do over Zoom because it just has a different feel to it. When you're actually looking at somebody and having that conversation, you get more out of it than something we would have done over the phone. We just never really had thought to do it because conference call was sort of the more natural thing to do. We've always asked all of our companies to have contingency plans as a requirement for us as part of our annual budget. I think that becomes even more important when you go through something like this and you realize that something completely unforeseen can happen, and makes it having those plans ready to go is just a real time saver, and you know what you're going to do immediately versus having to spend a month trying to figure it out. So I think there's some learnings here. I don't know exactly what when it's hard to imagine, I guess, the world a year from now, 2 years from now, whatever you think, when there's a vaccine and we're back to some level of normal, how things are going to change. But there are at least little things that will change for us on a more permanent basis.
Yeah. Well, we're fortunate that we do chemicals and life sciences, and we have some real leading experts on life sciences in the firm. For example, we have the most immediate past Deputy Commissioner of the FDA in charge of all drugs and medical devices, who is a senior member of the firm. So we have a pretty good idea of what the outlook is for the virus, and it's pretty ugly. And there are a lot of things that people are hoping going to work, but the chances that they are going to work and they can get distributed is going to be tough. So I think it's going to be with us for a while. Turning to the broader topic, if you look at chemicals, so as I said before, chemical industry didn't really start to look, private equity didn't start to look at chemicals much until, 99, 98, and so forth. And then for quite a while, the private equity had 25% market share of all acquisitions of chemicals for a really long time. And it was a very popular area. It really went well. But the last 5 or 6 years, so this is not a pandemic driven phenomenon. Private equity share of chemical M&A has gone down pretty dramatically. And there are a lot of reasons, one of which is a lot of deals are happening in China. And last thing I checked, um, the enthusiasm for doing an LBO of a Chinese chemical company is not particularly high. But the other is, preference for specialty chemicals versus commodity chemicals, which is clearly the case in your case, right? Which is most of your businesses are specialty. So as a result, the share is pretty low. So I guess really two questions. One is, have you felt that in terms of, the difficulty of doing acquisitions in the last 4 or 5 years that has been true for the industry as a whole? And I guess the other is, if you look at your crystal ball over the next 5, 10 years, what do you think the environment's going to be for private equity with regard to the acquisition side of chemicals? There's the divestiture side, which has a different personality.
Yeah, so we've talked about this before in terms of what the data says. You're right. We are called American Securities, so unlikely we're going to be doing those LBOs in China. But as it relates to North American businesses, I understand what the data says. I don't see it though day to day. I mean, I look at the number of opportunities. We track all this number of opportunities we're looking at in chemicals that fit within our size range and are could be interesting for us. It hasn't changed materially over the last 4 or 5 years. It's pretty consistent with where it was the previous 5 years. And it hasn't changed if I look at over the last 24 months, putting the pandemic aside, where activity was slow for at least a few months. It hasn't changed materially just in terms of activity levels. So I don't feel that as much. In fact, if anything, our data would suggest there's even more opportunity in our size range anyway than there may have been in the past. And part of that I attribute to, as you know better than I do, there's, every strategic's always sort of rejiggering their portfolio and either in trying to streamline or trying to become, more diverse. And, that just leads to a natural level of churn in the industry and opportunities for people like us. While the sponsor activity may have slowed, I think there's probably more chemical assets in sponsor hands today than there was 5 or 10 years ago because of the increase in activity among sponsors. And obviously those all will become actionable opportunities for somebody like us at some point. And we also have a number of public companies that are in our size range that over time have become maybe more interested in having dialogue. They're not as excited to be a small public chemical company in today's market. Maybe haven't seen the run up that other industries have seen, and think it's maybe not the best capital structure for them. So we're seeing activity across all those different areas. So I don't see it. I mean, I don't see less opportunity for us in the space. The one thing I would say that's changed, which you alluded to over the last 5 years, is the level of competition. So it feels like every year we see more private equity firms interested in chemicals, for even ones who haven't spent time in the space historically. We see more firms, promoting somebody to be, to give them the opportunity to, I'll call it, run chemicals, or at least maybe they don't have a title, but to spend significant amount of time in chemicals. And so we see new firms, new people trying to get involved. Some of those try for a year and maybe they don't make an investment and they, decide to focus on something else. But it feels like somebody new, or 1 or 2 new sponsors every year that are focused on chemicals. So it is increasingly competitive. Valuations are up accordingly, and I don't expect that to change anytime soon.
Yeah, which means you have to just add more value to really create value.
That's why we're so focused on this resources group and those 50 individuals to try to pay that market clearing price, but have a reason that we're paying that market clearing price.
Yeah. By the way, if one of the measures for us of how many people are interested in chemicals and private equity is how many inbound unsolicited emails we get from people saying, well, we're thinking about doing work in chemicals. You're a leading firm in the space. Could we talk, and so forth. And we get that pretty regularly. So that's sort of a anecdotal, actually a data-driven, support for your comment about just the number of people who, seem to be getting into the swimming pool, right?
Sure.
What I'd like to do is, because as I said, I wanted to leave the last 10 minutes or so for questions from the audience. I want to remind people that there are two ways that you can ask questions. One is through the Q&A function. The other is the chat function. And all you have to do is just type it in, and Scott and I will be able to read the question. So the first one is from an anonymous attendee, but the question is a very good question, so I'm not sure why it's anonymous, but it's, hi, Scott, how does American Securities Support Group work with your portfolio companies to adopt digital transformation strategies? So it's a good question. Scott?
It's a great question, and in fact, something we've been spending a lot of time on. A guy named Jerry Hughes, who's in our resources group, used to run a Salesforce firm called Blue Ridge, and they work with companies on digital strategies. And Jerry's working with two of our chemical companies, real time, and Jerry has two other people he works with, and so we're working with the companies. It was something we were focused on pre-pandemic, and it's become more and more critical during the pandemic when our salespeople aren't out there traveling and getting in front of people. So it's becoming a more important channel to reach our customers. I would tell you that our chemical companies, maybe this isn't surprising, are slower to adapt than many of our other companies. I think it's still relatively new within the chemical industry, and it's something that has taken time to, I'd say in some cases, even convince our management teams that it's something worthwhile pursuing, because it doesn't happen overnight. But we have the resources in the group and are very focused on it as we speak. Good question.
Second question is from Bruce Orr. He says, given your large target EBITDA for acquisitions, I guess meaning because your fund is larger, so you don't do small deals, you do larger deals, how many potential targets are you and your chemicals team examining at any given time? And has this changed since the COVID slammed us? Interesting word, slammed. So slammed us, right?
Right. So it depends. So examining can mean a lot of different things. So, the way I think about it is we have 5 different themes within chemicals I won't get into that we're focused on, where we think there's industry tailwinds and we think there's interesting opportunities. And each of those themes probably have a handful of companies, specific targets tied to them. There's different levels of actionability tied to those targets. So any given time, we might be in conversations with 7, 8 companies, but they're conversations that are happening once every couple months because it's clear they're not interested in doing anything. It's more relationship building and gaining knowledge so that when they do decide they want to do something, whether that's 6 months from now or 2 years from now, we know something about it and are well positioned to do something. So that's not a huge time sink, but it's really important to build the pipeline of things we know we want to invest in. In terms of examining, meaning doing real diligence, I'd say on average any given time we probably have 2 to 3. One of those is probably something we're deeper into and spending real time. 2 or 3 might be early stage, but that can change, right? We can't always control when sellers decide. We can never control when sellers decide they want to move forward. And so sometimes we might have nothing going on for 3 months, or limited going on for 3 months, and all of a sudden 5 opportunities that we know we're really interested in come at the same time, and we have to figure out how to resource those. In terms of how COVID's changed it, for the first few months of COVID, it was, there was nothing to look at. There was a couple of companies that needed to do something because they were forced sellers, but for the most part, companies were relatively healthy, and so there's nothing to spend time on. That has changed dramatically over the last maybe 2 months, 6 weeks or something like that, where everybody's realized things are not good, but stabilized. The financing markets are strong, and lots of people who have put processes on hold or delayed starting processes are now are now out there, and so we're relatively busy at the moment.
So the next one is what I call a multiple warhead question. There are two questions in one. So I'll read the first one, and this is from Hamad, which I hope I'm not mispronouncing. American Securities seems to have a long-term approach in holding for a longer period, whereas generally private equity companies flip every 5 to 7 years. Can you explain why? Now, the question is, can you explain why American Securities has a longer-term approach, or can you explain why private equity flips at 5? So you can answer either way that you might want to answer that question.
Yeah, I mean, our longer term approach, our view on that is we want to do things for our companies that are in the best long term interest of the companies. And so if you think you're going to be investing in a business and you know for sure you're going to sell it for 3-4 years later, you might make different decisions. You might not make the acquisition in year 3. You might not go build a plant in China in year 2 because of the time it's going to take to go do that. You might not invest in significant R&D resources because it's a 2-year sales cycle. Our view is if those are the right things to do for the company, you're going to create value for our investors, for our management teams by doing that. And if you have to hold longer because of that, that's okay, because we're going to get paid to do that because we're creating value for the companies. A lot of our exits are actually driven by our management teams, where we said we're going to start at X and get to Y, and we get to Y, and the management team says, well, feels like a really good time to sell. We've executed, and I have my money tied up here. Can we think about exiting? And if we all agree it's the right time, that's actually what drives a lot of our exits, and that's why typically we're not holding for 25 years. So that's, I guess, my thought on that. I mean, why private equity firms do it? It's because you're looking to return capital and generate returns for investors and for the PE firms themselves, and doing that sooner is a good thing from an IRR perspective.
Yeah. Actually, when I was with the Whitney family private equity firm, where all their capital was permanent, right? Apart from the Whitney family, partly. So like American Securities, they could take, actually they didn't have any time frame. They said it's as long as we want to. But I guess their feeling was sometimes the best shareholder value was created in later years, not in the first couple of years. And you didn't want to feel forced, because your limited partners expect you to return the money, to be able to liquidate. So that's having the flexibility, right, is the important thing, I think, for you, right, Scott? The last question may or may not be reasonable, because I don't know whether you ever did anything in this sector, but Hamad says, secondly, in recent years, many distributors are snapped up by private equity firms in the U.S. and actually, it's been for a long time. It's going on for quite a while. What advantages do they see in distribution services, and what do you see in the future of the business? It's a little bit of an unfair question, because I don't think you own a distribution business, right? But the question's a question, so I've read it.
I'm hoping you can take that one, Peter.
Well, just off the top of my head, chemical distribution is very different from chemicals. The very nature of the way it's structured. You don't make things, you distribute them. And the distribution business in chemicals has gone through a lot of consolidation and change. So I think it's been very successful for some people, where they bought the right company and the structural changes were in their favor. And for others, it's been very difficult, right? Because things have gone in the wrong direction. But it has been an area where private equity has been very active. Well, let me see if I think there's 1 or 2 more questions. Okay. Julie Vaughn says, what are your criteria for exiting investments? I think you partially answered that. And has COVID changed this?
All right. Hello, Julie. Yeah, we don't have a specific criteria for exiting investments. It's really bespoke to the business, and part of it's driven by, has the company performed well? So have we generated returns, we think, for us and for our management teams? It's the market environment. So does it feel like a good time to sell? Meaning there's likely to be interested buyers, whether that's sponsor related or, more importantly, strategic related buyers. So that's typically important. is the outlook of the company strong? So, we want the outlook to be strong for the next buyer, because of course that's how you really get paid the right multiple for the business, if you can show that there's more opportunity for the next buyer. So we have a fair amount of opportunity that the next owner can really bet on and invest behind. The financing markets there. So there's a lot of different things. Again, the management team, does the management team feel like it's the right time to consider an exit? It's rare for us to look at investment. Management teams, absolutely not. I would never think about exiting now. We have that conversation. It's rare that we're complete misalignment with the management team on an exit opportunity. So all those things are factors, and I can't tell you exactly how much each one is weighted, but there's a lot of different criteria. I don't think COVID itself has changed the criteria. It might change where we're ranking on those different criteria, meaning is it the right time and has the opportunity for, is the number of interested buyers the same and those types of things, but it hasn't fundamentally changed the criteria itself.
So last question, and then we're reaching the end of the hour, and so this will be the last one. With more and more companies being sold from one private equity firm to another, how do you add value and find attractive returns when presumably the last firm has already improved results, I guess cost reduction, et cetera, assuming you buy a company from another private equity shop?
Yeah. So, well, Peter, I think you said it earlier. Not all private equity firms are the same, right? People have different approaches. When we actually look at our returns and we compare returns where we bought from another sponsor versus primary buyouts, the returns are actually just as good and maybe even a little bit better for investments we've made where we bought from another sponsor. And that doesn't meaningfully change actually if it's from, if we're on our, third buyout or fourth buyout even. And but we're of course mindful of who the existing owner is and what they have or haven't done. Most firms don't have the resources group, the 50 people that we have. And so even investments that have been successful for another private equity firm, we might look at it and say they did XYZ and that's how they made money, but they haven't really touched these other three areas where we think we can add value. Maybe that's growing international, maybe that's operational improvements they haven't focused on. Maybe that's M&A where they were focused on getting things right internally, but because of that, they haven't prioritized M&A. Maybe it's a smaller sponsor that cobbled together 2 or 3, mid-sized businesses and created something that's now scale for us, but is now a very large investment for them, and they're looking to exit because it's just become a very large investment, and they want to exit, get that out of their portfolio. So it could be a whole bunch of different reasons. We're mindful of what the prior sponsor did and what opportunities may not be available to us, but it doesn't mean there's not other opportunities that will be available to us, even if it's been owned by 1 or 2 sponsors already.
So with that, we've reached the end of the hour, and you've asked a lot of good questions. We've had a good audience here. There are just 2 things I want to say. First of all, I really want to thank Scott for being really a wonderful panelist, a wonderful speaker. I think the issues we've discussed and the insights from the last 50 minutes really have been very special and very, very helpful. And so Scott, I want to thank you for that. And I think the other is, I think most of you know Societe de Chimie Industrielle. Those who don't, there are a number of missions in our charter. One is to help disseminate useful information to a variety of our constituencies, whether they're students or industry executives or financial people and so forth. And this webcast is a good example of that. But the other is we have a huge program related to giving scholarships, research scholarships to students studying in chemicals and life sciences, as well as a mentor program that we encourage all of you to be part of, where you can help students making career decisions, et cetera. So it's been a very, I guess, Societe's really been very active in doing very good things. I encourage you to to join as a member. The cost, the annual membership is $60. It's not very much, but it does give you various rights, including copies of speeches and recordings and also the list of the people who attended various webcasts. So it's very, very useful. And last, we've instituted two new things the last couple of months. One is a virtual networking hour, which has been very popular and extraordinary that we've had people from India, Bangladesh, Munich, and it's at 4 o'clock in the morning. It's just amazing. But the others, we started a series of discussion groups where there are no speakers. What it is we just get a group of people together to talk about an issue. We did one on digitization. We did one very recently on plastics recycling challenge, and they're wonderful because it gives everyone's a speaker, and you can be an expert or you could be someone who just wants to learn, but it's also a great way to meet other people. So I encourage you to, register for our webcast, our regular webcast, but also to participate in these happy hours and discussion groups. And of course, we encourage you to be a member and be involved in a mentor. So with that, thank you all. And we hope to see many of you, or at least get questions from many of you on November 18th when we have our webcast on startups in the chemical industry. So thank you very much. And thank you again, Scott.
Thanks, Peter. Thanks for having me.